All right, if you're looking to buy a house and you want to take advantage of FHA financing, don't go away. I'm a mortgage broker with over 20 years of experience, and in this video, I'm going to give you my personal pros and cons of FHA loans, along with how to qualify for an FHA loan, and also if you want the next steps on how you can get pre-approved for FHA financing. Now, do me a favor, if you like this video, make sure to hit that like button, and also do me a favor and subscribe to the channel so you get more content like this. So let's dive right into this. Let's talk about the pros and cons of FHA financing, because after all, no matter how good something is, there's always something that's bad about it, right? So one of the biggest pros is that you have a lower down payment requirement versus a lot of other types of financing. Although you could kind of make an argument with PMI, it's the same thing. But you have low down payment requirements. You also have low credit score requirements and credit worthiness requirements. It's very flexible when it comes to underwriting and credit guidelines to get FHA financing. FHA also allows for higher debt to income ratios than, say, conventional financing, like your Fannie Mae, Freddie Mac style loan. Now, something else that a lot of people like to point out with FHA financing is that you're going to have lower interest rates than conventional financing. But when I get to the cons here in a sec, one of the things that you got to weigh out when it comes to is the FHA rate better than a conventional rate is the mortgage insurance. But before I dive into that, the last thing that I would throw into the pros column is that the FHA loan, it's not just for first-time home buyers. Repeat buyers can use it, so you get to take advantage of the low down payment, the high debt to income ratio, the lower interest rates that FHA financing provides without the requirement of being a first-time home buyer. So let's talk about the cons, because for every positive, there's got to be a negative, right? So when it comes to FHA financing, hands down, the worst part about FHA financing is that you have mortgage insurance. But if you're making a low down payment, no matter what kind of financing you're doing short of VA, you are going to have mortgage insurance. So it's kind of a moot point in my opinion. But when it comes to FHA's mortgage insurance, it's for the life of the loan. That means that no matter how long you have the loan, no matter how much you pay the balance down, you're still going to have that monthly mortgage insurance, which means that you're probably going to want to refinance this loan in the future. Probably what a lot of people typically do is they refinance from conventional over to FHA. Now, another con to the FHA loan is that it's more expensive in terms of the fees. You're going to be charged 1.75% of however much you borrow. Now, it's going to be financed, so that means it's added to how much you owe, but it's still a fee. And remember, the more you borrow, the more your monthly payment, the more you pay over time. So that 1.75%, it does add up over time, and it does increase your monthly cost of doing business. So you got to factor that in to the FHA financing. So no matter what type of loan you're getting, there's always going to be loan limits, and the loan limits are based off of the county that you're buying the property in. Well, when it comes to FHA financing, you are going to have lower loan limits than you would find with conventional like Fannie Mae, Freddie Mac, or VA. So you will be a little bit more limited if you need to stretch your buying power beyond what the county loan limits are. Now, the last negative of an FHA loan, in my opinion, is that the seller, or more likely the seller's listing agent, they're going to view your offer inferior to an offer that's probably conventional or cash, because they're going to assume that because it's an FHA loan, that the borrower isn't as qualified and there's a chance that the deal could fall apart. Whether that's true or not could be argued. So let's dive into how to qualify for an FHA loan. And let's start with credit, because when it comes to FHA, that's probably one of the biggest benefits of FHA is the flexibility that FHA guidelines have when it comes to credit. Whether you're talking about your FICO score or your credit history, FHA is way more flexible than the other types of loans out there. Now check this out. With FHA financing, you can have a FICO score as low as 500. Okay. Now, if you do have a 500 FICO or anything less than 580, you're going to have to put 10% down. Now, if you have a 580 FICO or above, well, guess what? You can do the minimal down payment, which is 3.5% down. So when it comes to credit scores, FHA is super flexible. Now, I do need to point something out. Most lenders, however, even though FHA will go down to 500, most lenders, they won't touch anything under 620. So You need to make sure that you're talking to a lender like New Way Mortgage that does work with clients that have FICO scores as low as 500. Not all lenders are alike. Now let's talk a little bit about your credit history. That's another thing that FHA is very flexible with. Let's say that you had a major credit event like a bankruptcy, right? You filed a Chapter 7 or a Chapter 13 bankruptcy. Well, with FHA financing, they'll allow you to get normal FHA financing with a 2-year history from the time of the event to the time that you're getting your FHA loan. So basically, like if you were getting your loan today, if you had a BK 2 years ago, it's basically no big deal. Now, there are some caveats. You can go below that 2-year timeline, but it becomes a little bit harder to qualify. You got to be able to show some extenuating circumstances or document more stuff. Not everybody fits into that box, but it's always worth checking that out. But 2 years is way better than 4 years, which is what you would find with Fannie or Freddie. The other major credit event that comes up a lot are foreclosures, short sales, deeds in lieu of foreclosure. So with FHA, they're also going to be very flexible. You only need to have 3 years. Yeah, you can get it with less under extenuating circumstances, but typically it's 3 years compared to 7 years with Fannie Mae or Freddie Mac. So again, FHA, very flexible, like a yoga instructor. Now with FHA, they're gonna look at your last 2 years of income history. So whatever your income ultimately ends up being, FHA has very flexible debt to income ratio requirements as well. They go higher than Fannie Mae and Freddie Mac in a lot of cases. Now, the way that it works when you're applying for a loan is the lender, they actually submit your application through a software program. It's called Desktop Underwriter. Now, the AI in this system is going to decide your creditworthiness and if you're basically approved or not for the scenario that you're applying for. If the software program, if DU says that you're approved, you can have a debt ratio as high as 56.99% with an FHA loan versus on Fannie Mae, Freddie Mac, you're capped at 50%. So you literally almost get 7% more wiggle room to fit into your debt to income ratio to qualify on an FHA loan versus conventional financing. That's another big reason why a lot of people like to lean on FHA financing. Now, speaking of computer programs deciding whether or not people are approved or not, let's say that for whatever reason, the software doesn't like you. Well, another nice thing with FHA is they allow for what is called manual underwrites, which yes, that means a real person, a human being, actually underwrites your loan. Now, in those circumstances, that's where your debt to income ratio requirements are going to get chopped down. Now, I'm not going to go too far into the weeds on this, but the debt to income ratios could be as low as 43% like cap. Now, you might be able to get it a little bit higher than that, but if you're doing a manual underwrite, your back end ratios, they can't exceed the 43% typically. Okay, so let's move on to assets. When it comes to liquid assets, FHA loans do not have any minimum requirements for assets. They do have a minimum investment requirement, meaning you make your minimum down payment, which is 3.5%, or 10% if you've got below a 580 FICO score. But they don't require you to have like reserves, money set aside in the bank for a rainy day, in addition to the money that you need to close your transaction. Now, keep in mind though, just like any other type of financing, that any money that is used to purchase the property, so if your down payment and closing costs were say $15,000, the lender has to document where that money's coming from. So we're still going to need the last 60 days of your account statements showing that the money's been sitting in there so that we can document, source, and season it. All right, now last but not least is the property. Now this is your collateral. This is the place that you're gonna buy. Now with FHA, this is one of the reasons why sellers, AKA listing agents, kind of, look down on FHA offers potentially, is because of the condition of the property that they're trying to sell. FHA is going to require that the appraiser do a little bit of a deeper dive than a conventional appraisal. Now, don't mistake this as a home inspection, where the home inspector is going to literally look at everything, go into the house, go into the attic, they test every socket in the house. That's a home inspection. I'm not talking about this. I'm talking about a home appraisal, but an FHA appraisal. An example would be on a conventional appraisal, the appraiser is just going to basically make sure that a heating source like an HVAC system exists on the property. they're not going to actually turn it on to see if it works. Whereas FHA, they will. Now, there are going to be certain things, though, on the FHA appraisal where they're just going to defer to a home inspector. They're not actually inspecting the property in that same essence. They're there to figure out basically if the property meets FHA's minimum standards, like not having a cracked foundation, things like that, and determine the estimated appraised value based off of their opinion. Now, before I dive into how you can get pre-approved for an FHA loan yourself, let me give you one more bonus piece. This is a house hack, and this is something that, like, if I could go back in time 20 years ago and, basically start from scratch, what I would have done is this. I would have used FHA financing, and I would have bought a 4-unit property. All you would have had to do is put 3.5% down. You get the FHA rate, and literally you rent out the other 3 units. You live in one of the units for a year, and then you move on to your next property. Go buy something else. But this is the cheapest way to build a massive real estate portfolio over time. But if you already own a house, you buy a house, and then you want to convince a lender that you're going to go basically live in one of the units in a fourplex so that you can get away with using FHA financing, it ain't going to happen. They're not going to buy it. So it's kind of one of those one and done situations. So number one house hack for FHA is definitely taking advantage of that. If you're flexible and you're willing to basically live in a 4-unit property, rent out the other units for the time being so that you could potentially have a 4-unit as an investment property down the road. I hope you got value out of this. Now, if you are interested in getting pre-approved for FHA financing, click the link in this video or go to meetnewway.com and you can schedule a free, no-hassle consultation with a licensed FHA mortgage specialist. They know all the ins and outs of the FHA programs. They're here in our office, and basically they can answer all of your questions and get you pre-approved for the loan scenario that you're looking for. Thanks for watching this, and do me a favor, like this video if you got value out of it, and make sure to subscribe to the channel so you get more content like this. See you on the next one.